What implications will Thursday's announcement by Federal Reserve Chairman Jerome Powell have on the markets and the economy? To find out, we've asked today's expert guest, Danielle DiMartino-Booth. Danielle knows the Fed inside and out, having worked there as an advisor during the great financial crisis, and she's not very happy with what Chairman Powell said. To find out why, keep on watching. Oh, and if you're enjoying the high caliber of expert guests that we've been getting on these programs lately, please be sure to click the like button below. The more likes these videos continue to get, the more big names we're able to attract on the program. And now, let's get started watching today's market update video featuring Danielle DiMartino-Booth. Hello everybody, Adam Taggart, co-founder of Peak Prosperity, welcoming you back to another week of making sense of these markets. This week we are extremely fortunate to have a very special and timely guest. We have Danielle DiMartino-Booth. Danielle is the CEO and Chief Strategist of Quill Intelligence, which is a research and analytics firm. More importantly, she is the author of the book Fed Up, an insider's take on why the Federal Reserve is bad for America. You've probably seen her on CNBC, Bloomberg, a whole host of other financial TV shows. And she's always in such high demand, both for the quality of her analysis, but because she is a Fed insider. Prior to founding Quill, she worked for 9 years for the Federal Reserve in Dallas as a strategic advisor to Richard Fisher, helping him navigate the great financial crisis. So she's got a strong sense of how the Fed is run and who is running it. Of course, today we just had Jerome Powell give his notes from Jackson Hole and release some very interesting news. And rather than give you guys a summary of it, we're just going to get Danielle's real-time take. But anyways, first, Danielle, thanks so much for joining us and welcome on the program.
It is great to be here, especially today, since we've got a lot to talk about.
All right, well, let's jump right into it. Quickly, right before we do, just want to say that we're also joined by the lead partners from New Harbor Financial, as we are each week. This is the financial advisory firm officially endorsed by Peak Prosperity. After we get a chance to chat with Danielle, John and Mike and I will go through sort of what the markets have done since the last time we all got together last week. But Mike and John, good to see you guys.
Hello, Adam. Danielle.
Howdy.
Good to see you, Adam, and hello, Danielle. Great to be with you.
Absolutely.
All right, Danielle, so let's kick off. Really want to hear what you have to think about, or what you think about what just happened there in the Jackson Hole speech. But before we do, if you could just give us your high-level, honest, no-holds-barred assessment of where you think markets are today and the impact of the role the Federal Reserve, if any, is having on those markets.
Well, I think the Federal Reserve is the markets. We talk day in and day out about the increasing concentration of the stock market. I think Jeff Bezos is now worth $200 billion. Apple's worth $2 trillion. This all ties back to Fed liquidity and not much more. People don't quite understand the relationship. It's difficult to explain quickly, but I'll try. The relationship between passive investing, indexing, and Fed policy. The long story short is the Fed has helped foster the big getting bigger by making sure all investors understand that the last thing they can do is try and fight the Fed. So if you don't fight the Fed, that means you don't need active management, which means you do need passive management, which means you're going to foster the monopolization of the U.S. economy, make the bigger, as big. I think concentration has only been this high in 1929 and in the year 2000. So yes, the Fed plays a huge role in the stock market. And of course, now the bond market, because they buy that too.
All right. Gosh, great summary. Very consistent with a lot of what we've been saying over the past weeks and months on this program. Got to say, a little depressing to hear it from a Fed insider, because you always sort of hope that these are geniuses with a master plan and that things are maybe different than we little people perceive. But I did like the term that you mentioned, which was sort of a monopolization of the markets and the economy. There's a whole bunch of inequity and all sorts of things that come along with that as well that we can dive into. Before we do, though, why don't we get to the brass tacks about what the new news today was. So Jerome Powell got out there, talked about how the Fed is switching to an average inflation management program. I think that's the big news, but if you think there's even bigger news than that, go for it. But what did you take away from today's speech, and what do you think the repercussions are going to be going forward?
So I think he actually introduced the idea of unemployment shortfalls into the discussion because the Fed right now is trying to figure out how to finance a wartime level of debt in this country. And so I think he looked back to World War II as an example. And during World War II, of course, overnight rates were held for more than a decade, actually, at the effective zero bound of the time. There was no Fed funds rate back then. And in order to get cover to hold rates for even longer, why target inflation if you can instead say there's no more empirical relationship between the inflation rate and the unemployment rate, which he said. And ergo, what we're going to focus on in order to get our second mandate, maximizing employment and make sure that we keep rates low enough for long enough for it to trickle down to the little people, because we know that only 7 years worth of the zero bound, that was only good enough to work for the big people. So they're looking for something that will allow them to keep rates low for like a decade. And to do that, then you look for unemployment shortfalls. And that means that they want to take another decade to get the unemployment rate back down to, 3.5%, a half-century low. And in order to do that, they're going to now target unemployment instead of inflation. Now, by doing so, inflation might start to run hot, but that's okay. They've got cover for that. They're going to make up for their past mistakes since they haven't been able to hit their target since 2010. They're not going to hit it again either because they have the wrong inflation metric. But long story short is Powell served up a bunch of poppycock today. I'll use a polite word, and simply gave a reason in economic jargon to hold rates at the zero bound for a decade.
All right, so we've had historically low interest rates pretty much at the zero bound since the great financial crisis. We had low unemployment, and yet we had this exacerbating wealth inequality happening in the country. So is there any reason to think that by doing another decade of the same, that we're going to see different results? Or really is the rational expectation here to think, look, if the rich have been getting richer at the expense of the remaining 99% of us, is that pretty much likely what's going to be happening with this policy if it's indeed enacted?
Probably so. I think right now there's a lot of poppycock going around about this idea that we're going to have a very short, abbreviated spell of unemployment. Nobody seems to talk about the fact that a lot of the travel and tourism industry is going to go away permanently, and that a lot of small businesses are closing, and that 25,000 retail locations are going to close this year. Nobody's talking about record bankruptcy run rates, and the fact that we've had a decade of piling debt onto corporate balance sheets. So instead of restructuring, they're liquidating. So there's a lot going on that suggests that this unemployment spell might not be short. And therefore, it's going to be a matter of lower for even longer. Inequality is going to be even worse with so many people displaced from the workforce. We've heard from Washington, D.C. that they prefer to fight with each other as opposed to pass another round of stimulus. I paraphrase. So inequality is just going to be something that gets worse and worse. And in a very sad way, to quote Jim Grant, the Fed being both arsonist and firefighter, they know that Wall Street's going to be fine even if Wall Street blows up, if the market blows up and it just takes down those wealthy people, but they've already got plenty of municipal bonds and cash anyways. They know that Wall Street's going to be fine if Wall Street blows up. But if the stock market blows up, they know that trickle down actually does work when it comes to trickling down to the little people.
All right, so we've talked a lot in this program that we believe, at least, that the Fed is largely in a corner of its own making, right? By intervening as much as it has basically created a zombie economy and zombie markets, right? And so if it stops the liquidity, if it stops the stimulus, the markets immediately begin to go into cardiac arrest, right? And I think we really saw this in Jerome Powell's reversal at the end of 2018, right? Where he was talking a big game, balance sheet reduction, rates were going to start going up. The market threw a hissy fit, and he just basically did a complete 180, and it's been off to the races ever since. So the question is are the folks at the Fed, I'm going to sort of go back to my original comment, do they have a plan here? Are they playing to some sort of playbook that they have some credible hope is actually going to work out, and they're smarter than maybe we're giving them credit for? Or are they just regular people who are saying, look, we're kind of stuck in this problem that we don't know how to get out of, and we're just playing for time. We're just trying to keep things going, keep the train on the rails for the next quarter or two, and we'll figure out once we get to the future quarter what we're going to do then. What's more closer to reality?
I think it's definitely the latter. You're right. Jerome Powell found out that the markets of the Fed's making were bigger than any one man who was going to try and normalize and rationalize monetary policy when the junk bond market shut down for 41 days. And ETFs, the collateral backing bond exchange traded funds, the collateral was trading by appointment only. So he understands the magnitude of the problem. He keeps begging fiscal authorities to pass more stimulus because he knows he can buy that paper. He knows he can monetize the debt, but he doesn't know he can do much more than that. And if you look at the Fed's other facilities that have been created, and they were created with much fanfare, there really hasn't been much uptake. The swap lines have been the most used of all of the facilities, but as far as some of the other credit facilities that have been created, they really haven't done a whole heck of a lot. And so they know what they need to do is more quantitative easing to buy the time you reference, and they're hoping that the fiscal authorities come in and really give them a helping hand. And yes, it's the worst possible policy you could ever conceive, is to pray for time. But that's basically, pray for time. They would save a lot of taxpayer money if they just put those 3 words out every 6 weeks, every 8 weeks or so. Just we're still praying for time. Status quo here, no change in monetary policy.
Okay, great answer. Again, maybe a little more depressing than I was hoping for, but I appreciate the honesty.
I'm not saying there are bad people at the Fed. I need to back that up. There are definitely good people at the Fed. I was proud of Dallas Fed President Robert Kaplan. He came out today and said, somebody asked him on one of the Bubble Vision shows, should the Fed be buying Apple bonds for the next 10 years? And he said, well, no, at some point, markets need to be, taken away from this level of stimulus. So at least there was one adult in the room, which, by the way, goes against Jerome Powell saying that there was perfect, unanimous, it was all kumbaya, happiness, no dissent. There have to be rational people at the Fed who know that they're making the problem worse. In fact, if you look back to 2012 transcripts from the December FOMC meeting, Powell himself spoke articulately against what he announced today.
Yeah, it's amazing what people will say before and after they hold an office versus what they'll say during it. And look, I'll say, if I were sitting in the Fed chair right now, I don't know how I would solve that problem, at least the way that the population would like me to solve it. But 2 questions for you coming off of that. One is, you talked about sort of the happy talk that Powell said today. How come nobody in the media is holding this guy accountable? Like, where are the tough questions?
I listened to a lot of the commentary today, and I was just, my second master's is in journalism. So it is these people's jobs to ask hard questions, to probe, to say, what are the unintended consequences? What are the intended consequences? And yet, most of the people I've heard interviewed kept saying, this is a monumental shift in Fed policy, and this is just, it's amazing what they're doing in the name of the people. And I'm like, oh, you're really going to get away with this? And it's sad to see. It really is. I can't watch the press conference Q&As anymore after FOMC meetings, because it's like everybody make way for the elephant in the room, but nobody's going to recognize it. Nobody's going to ask the questions.
Yeah. So I'm just going to ask you to speculate. But why do you suppose that is? Do you think it's because the people that own the news organizations are telling them to toe the line, or is it just hero worship, or the Fed is saying, look, you can come to the conference, but no tough questions?
Well, there is an element of that for sure. In fact, a person will go unnamed, but one person who asked a very difficult question was shown the door of his news organization. So
I know exactly who you're talking about when that happened. Yeah.
Exactly, and exactly why. And by the way, what he was asking about happened. But to that point, no, I don't think you're really welcome to speak. I'm on many news programs and I try and be as delicate as possible, but you can also be as delicate as possible and still talk about some of the ramifications of Fed policy. But that is done very rarely.
Yeah, sadly. I mean, part of being a good journalist is having courage and stepping up to ask the questions, even if you know that folks don't want to hear them. All right, look, two last questions for you, because I know we've already taken a ton of your time, and thank you so much again for coming on such an important day. I just mentioned that if they put me in the chair, I don't know how I could navigate an elegant way out of this. Certainly not a painless way out of this. Are there particular solutions that, with your background, that you advocate for, that you think the Fed should adopt or take here?
I think that the Fed should. I think that the Fed should stop fostering long-term sclerosis in the economy. And when I say that, it's knowing that there was going to be pain. A good crisis was wasted in that the Fed did not have to come to the rescue of insolvent companies with bad business models. They would have been a lot better off going into restructuring, as well as the employees of the corporations would have been a lot better off. So, I mean, had I been in a position of authority at the Fed, I would have let some creative destruction happen. I would have allowed the fallen angels to truly fall, the investment grade bonds to get downgraded to junk, and then to suffer the ramifications of being downgraded to junk as opposed to being bought, because the Fed put a floor underneath them. So we're going to have with us for, I don't know how long, 1 in 5, 20% of US companies that are zombies. They don't have sufficient profits to cover their interest. That's going to act as a long-term drag on the economy. And that is a fact, that is a product of Fed policy. And they didn't have to take it this far. They could have let the coronavirus be the catalyst to allow for a much more robust recovery when we get into the next recovery, by making room for new entrants, innovative companies, job creators in the future. And instead, they've kept the deadwood alive with $2.5 trillion and counting dollars of corporate bond issuance this year alone.
Yeah, I am shocked that they didn't use the coronavirus as a better out to the situation. I mean, it was sort of a get out of jail free card, right? To do some of the stuff that they feel their hands have been tied on, and they could just blame it on the coronavirus, right? And let the detritus go out, let the malinvestment correct. And they chose just to triple down on their previous.
They did. Instead, they chose to make special purpose vehicles at the Treasury because what they were doing violated the Federal Reserve Act. And now we need to bring back, which is a whole nother discussion, another 1951 Plaza Accord to redraw the lines between the Fed and the Treasury Department. I mean, this is a disaster.
Well, so I can't, I guess, let you leave without asking this question then, which is, how independent is the Fed really from political pressure?
It was, I mean, they allowed themselves to be the product of a leveraged buyout of the US Treasury Department. I mean, they basically answered to the president at this point. And the thing is, Powell was the least political Fed chair since Volcker was in the building, literally. I mean, Greenspan and then Bernanke and then Yellen, they all kept interest rates artificially repressed because Congress wanted to spend too much money, and Congress needed to be able to tell the people that the debt was manageable, but it's only manageable if you have zero interest rates or very low interest rates. So they were much more malleable. It was just polite and quiet. And Powell came in like a raging bull. And his first congressional testimony said that it wasn't the Fed's job to backstop the stock market. So the opportunity was there. And you're right, the coronavirus is a crisis that was wasted, because he could have furthered his goal of rationalizing monetary policy by allowing insolvent companies to restructure. And instead, they've put on so much more debt that when the time does come, there won't even be an opportunity to restructure. They'll have to liquidate.
Yeah, it's just crazy. One wonders if Jerome Powell woke up with a horse head in his bed at some point in 2018.
Hey, I'm Italian. If he did, then I put it there.
Okay. Well, hey, last question for you, and then we'll let you go. So I'm going to ask you to speculate here again, but we got a lot of concerned investors who are watching this program and really trying to figure out what the heck they should do, right? They look at the markets, they look at Apple, hitting 2 trillion, they look at the incredible deformation of market asset prices today versus any kind of underlying fundamentals, right? And the fact that, given the trillions that the Fed has released and that Congress has thrown into the mix too since the virus outbreak, you can just see that direct relationship between that tsunami of liquidity and asset prices continuing to shoot the moon now to, in most cases, to record highs. So they feel like they're walking a knife's edge here, where they're saying, look, if I'm looking at the momentum, it looks like the markets are just going to melt up forever, right? And the Fed is telling us every day they've got our backs, and everyone's just saying, learn to love the Fed and just ride it. Don't fight the Fed, as you were saying earlier. But then you have a lot of people who are, critical thinkers who are saying, look, this can't continue forever. We've seen issues or episodes like this throughout history. They end really poorly and suddenly, usually. And so investors are really trying to wonder what to do with their capital. I think they want to be positioned defensively, but they don't want to, not only miss out on future gains, but they don't want to just be sitting like in cash instruments and just have that inflate away over the next 10 years. So do you have a sense, do you have a strong opinion either way of where the markets might be headed? But more importantly, just what would be your general advice to today's concerned investor?
Well, there are good managers out there who can study up on their Black-Scholes model and investigate ways to find cheap protection out there. I mean, it is out there for the taking. I mean, don't buy November puts. They're a little expensive around election day. But there are ways to protect what you hold. I have a great municipal bond manager who owns individual municipal bonds for me. That's been a true home run. If we think taxes are going up, and golly, they might, that makes something like a municipal bond even more valuable if your federal income tax rates are going to go up. And look for buying opportunities. Look for Jerome Powell saying that inflation expectations might be running too hot, and he would be okay with that on the same day that the Wall Street Journal is running a story that grocery stores are having to reduce prices. So look for obvious disparities that say, well, but there's deflation in the real world. The Fed's out buying the tips market. Literally, the Fed is out buying the tips market. A lot of fast money investors followed them. 12 straight record weeks of inflows, $11.1 billion into tips funds, because some investors follow what the Fed is buying. But there are opportunities when you see interest rates back up and you've got an opportunity to get in there and re-up your position in your treasuries. And I wrote 5,000 words a few weeks ago on how the 10-year treasury could likely go negative nominally all by itself, without the Fed funds ever becoming negative. But there are ways to protect yourself. If you see gold get cheap, buy a little bit more of it. I mean, these are no-brainers. You know that in the end, correlations in your asset classes are going to line up to 1. So buy your protection. Make sure you've got gold in your portfolio. And I'm no gold bug, but just, you need something that's going to be a true diversifier for your portfolio. And again, study up on those puts. And when they're cheap, buy them.
All right. Well, great answer. Danielle, thank you so much for making the time in your extremely busy schedule. I know we interrupted your writing of your post for today, so thanks for taking the time out to do that.
Got to get back to poppycock.
Poppycock. I appreciate you giving us the PG-13 version too. But loved having you on. Hopefully we can have you on again in some future month. You're a wonderful guest. As we let you go, to provide a transition for me chatting with the guys at New Harbor, John, it looked like you had a question for Danielle. Maybe you could ask that quickly, and then Danielle will let you head on off.
Sure.
Yeah, thank you, Danielle. There's a lot of folks that really view some of the recent policy actions that have been conflated between Treasury and Fed as really being effectively an illegal violation of the Federal Reserve Act. With the Fed going out and buying corporate and junk bonds, they're not allowable collateral under the Federal Reserve Act. I wonder if you could speak to the legality of it, and more, just as importantly, if it does pretty clearly broach that threshold, why isn't Congress doing their job to enforce this?
Well, right now, Congress isn't doing their job at all in any capacity. And you can only hope because a huge crop of senators and Congress people have left who were really the Fed watchdogs on the Hill. So we need a new generation on the Hill to, again, bring forth another 1951 Plaza Accord and redraw those lines, because in any other world, somebody would have recognized that the Federal Reserve, which is supposed to be an independent government agency, at least the Federal Reserve Board in Washington, D.C., in any other world, they would be like, well, gee, they're using Enron and WorldCom accounting to get around, to skirt the law. I mean, it's prima facie evidence, for heaven's sakes. And that's why I think that once the dust settles, especially if there is not a super happy ending to what the Fed is doing, that there will indeed be more scrutiny, and hopefully somebody makes the Fed independent again, whether they want to be or not. That is, I mean, we do have 3 branches of government, and at last check, the Fed's not the 4th, nor should it have the authority to be so.
Thank you, Danielle. That's very helpful. Thank you.
All right, Danielle, thank you so much again. Look, as we say goodbye to you, if folks want to learn more about your work, where should they go?
Please come see some samples of our research at quillintelligence.com. And if you have trouble sleeping, follow me on Twitter at DiMartino-Booth.
Great. All right, Danielle. Thanks so much.
Thank you. Take care, guys.
All right.
Danielle.
All right, John and Mike, gosh, again, what a great treat. Danielle did such a great job. So valuable, and at the same time, a little bit frightening to be able to hear from a true insider what they think, and when they think so poorly of at least the system as it runs today. It just validates a lot of our worst fears. You kind of hope these people come back with some data or some positive information that you're unaware of. But Danielle mostly seemed to just pour, kerosene on the fires burning in our minds of what's wrong with the system. Before we get to the markets, anything in particular you guys take away from that, Mike?
Yeah, I mean, I guess, like you said, it's a pretty sobering, response that she had to your questions. We too believe that the Fed is making it up as they go along, and they're going to keep making it up, and they're going to keep justifying and keep pulling rabbits out of the hat at every turn, because there is no plan B. That's what's sad about it all, is that they literally are hoping that it gets better on its own. They buy some time, another year, another year, another year. And it's very, very frustrating as a money manager because our business, the investment business, the whole sector, they're always making up kind of spin and excuses, or they're saying that there's certain things that can be done or value that can be found under certain rocks if you just look hard enough. Maybe that's true sometimes, but I got to tell you, at this point in time right now, returns have been flattened to zero across the board because prices on everything have been bid up. In a zero interest rate world, in a TINA, there is no alternative world, in a world where this fear of missing out, everything has been priced to perfection. In fact, everything, including the S&P 500, has been priced for negative returns over the next 10 years or so, by the way that we look at it. So it's pretty frustrating. Because one, as an investor or as a money manager, is forced to game theorize and try to, play a game where you feel like on one hand, you feel like you're being forced to jump into the market, and yet there's no way out in terms of timing it right. So it's frustrating. All we know is what we know in our heritage is that we're engineers, we're technical people, we like data, we think the data takes emotion out of things, and that's what we continue to fall back on. Data is extreme, therefore our positioning is extreme, with 0% net equity and waiting to be tactical on pullbacks in the market. When we hear people like Danielle and others say, well, the Fed's got this and they're never going to stop, yeah, it gets a little exasperating, but we'll continue to do what we do and keep saying our truth.
Yeah, Adam, I'd like to just comment. Danielle, I think, shined a pretty important light on the fact that, well, Jay Powell, in his comments today, wanted to give the impression that everybody was on board at the Fed, when in fact that's not the case. She pointed to Robert Kaplan, the current Dallas Fed president, of really pouring some pretty cold water on that idea. And that just reminds me that even going back nearly a decade ago, Well, in 2013, when QE3 was unleashed, there again, they wanted to present this image that it was solidarity at the Fed. This is the right thing to do. When in fact, folks like her former, she was an advisor, as you pointed out, to Richard Fisher at the Dallas Fed at the time. He was squarely against QE3. So there hasn't been this unanimous support for these crazy programs that have been taken, to the extreme over the last decade and more. There has been dissent, some very well thought out dissent. Unfortunately, it's been a minority dissent.
Yeah, well, I think as she said, it really is a group of people who probably are trying their best just to keep their fingers in the holes of the dike as new holes continue to break out there. I don't envy them their job. I can definitely say I don't agree with the decisions they're making and the policies that they're taking on. But I appreciate the fact that they're in a position where, if they make too big of a mistake, quote unquote, the system seizes up and really breaks. And I understand their desire to try to avoid that. When I asked Danielle to sort of, think of what advice she would give to an average investor, she didn't go to the, hey, things are so overstretched that there could be a real big breakage here. I'm going to put some words in her mouth that may or may not be accurate, but I think she probably holds out the potential for that to happen. But her comments were more sort of, hey, while this wave is happening, there are things that you can do to take advantage of it. If we do expect rates to be real low, maybe even go lower negative, she mentioned with the 10-year, there are things out there like muni bonds and whatnot, or things that are tax advantaged or tax free that would benefit disproportionately, especially if we're expecting more taxes to come, which I think is pretty easily predictable given the economic gut punch that most states have taken. What are your guys' thoughts on that? As you look at munis right now, is that something that you might consider in this type of environment, or are there things about them that make you nervous?
We do take a look at them, Adam, but, boy, the yields have been flattened across the board. I mean, if you look at spreads on all bonds relative to the risk-free rate treasuries, I mean, they're all extremely low, including munis. You're looking at maybe 2 points on average spread with munis and corporates. And there's this concept of credit risk, or, taking credit risk. I mean, you don't get something for nothing. And I think that we have forgotten that there's additional risk when you go into any spread product. For the record, we are predominantly in really short-term U.S. Treasury bonds and bills, really safe U.S. government securities. Municipal bonds have issues in our view. There's not a lot of extra compensation for the extra credit risk. And municipalities and cities in general have problems. I mean, I look at, certain places in California, or look at Chicago for
I was going to say, would you own a muni in the state of Illinois?
Yeah.
Probably not.
For what? For maybe 2 extra points? I mean, and there's a reason why after the swoon in March that municipal bonds sold off and corporate bonds sold off. Just look at the ETFs like MUB and LQD. They all sold off 10 or 15%. Municipal sold off 15% because there is a real risk. If things freeze up in the financial markets, a lot of these municipalities and cities are going to have problems. So we have not done that. I mean, it's not to say that there's not some value there. There probably is. It's kind of outside of our expertise, to be honest. And, we're focused on sectors in the equity market that make sense, on pullbacks. Certainly have been longstanding fans of the gold and silver mining sector. We've held that position for many years, and it's recently collared and hedged with options. But I don't know. I would rather say that we'd be looking at oil and gas producers and exploration companies on a pullback in the S&P versus looking at municipal bonds.
Yeah, I'd add to that. I mean, there's real. The yield is just not there. You look at the 10-year Treasury. Even after today, there was a pretty large move higher in yields on the 10-year Treasury. It's like 70.74% today, something like that. Even if it went to zero, you're talking about at most a 8-9% rally in the value of those bonds. That requires it to go to zero, and quite the opposite certainly could happen if the Fed loses control of the curve here, and we get a tick higher in interest rates here, despite what they intend to do. There have been times where the Fed has lost control of the interest rate curve, and it certainly can happen again. And you have a situation here where it doesn't take a big move in yields higher to completely wipe out 10 years worth of that pitiful yield in an instant. So it's a classic gun to the head environment, unfortunately.
Yeah, that's a great point, John. I wished if we'd had more time, maybe when we have Danielle on again in the future, I'll ask her this. But, back in the 80s, there was this thing, this group called the bond vigilantes. There actually were people that could push yields higher because they disagreed either with where the Fed was trying to set rates or whatnot, or thought that risk was higher in the system than current rates were projecting. And we're coming up on an election in the U.S. that could potentially be a contested one. And I think that would be a really interesting question to get her opinion on, which is, let's say that there wasn't a concession of who won the election and we got thrown into some sort of, big contest. What could that do to rates? What could that level of uncertainty do to rates here? So anyways, lots and lots of...
one thing, Adam, we talked about, look, none of us envy the position that the Fed... hold on a second. Sorry about that. Adam, one thing I wanted to point out, none of us, we all agree that we don't envy the position that the Fed is in. It's an impossible position, whether it's of their own making or not. But there's never a time where courage is not appropriate. Paul Volcker came in, did a hugely unpopular thing in the early 80s to break the back of double-digit inflation. That's what courage looks like. That's what's needed at times like this. Not cowtailing to the market, not spinning mistruths and double speak. What is required right now is people to come and do the courageous thing and the right thing and the thing they're tasked with doing. And that goes not only to the Fed, it goes to our Congress. I think the people are getting fed up. They certainly should be and will be when they see what's being done here. But good old courage is what's needed, not new theories about monetary policy.
Yeah, so the big question is, will we get it? I don't have a lot of hope, at least not in the short term, but we'll see. All right, guys, so in the couple minutes we have left, I just want to check in with you about market activity. I think the markets didn't do a hell of a lot over the past week or so because people knew this Jackson Hole speech was coming up. But is there anything in the lead up to today or in the action after Powell's speech today that you think is worth discussing for folks here?
Well, the market's been on fire, Adam. I mean, the S&P is up almost 100 points since we talked last Thursday, since we recorded last Thursday. That's close to 3%. And it's been up literally every single day. Most of those days have been on negative internals, less stocks up versus stocks down. Very narrow rally, all of the classic hallmarks of a market that you should be cautionary about.
Sorry for interrupting, Mike, but just to challenge you, there were 2 down days so far in August, just FYI.
And they were hardly down. That's right. Yeah, almost no down days. And the internals are bad, and the market is screaming caution, and yet it doesn't matter. It just defies all reason. It continues up, and it doesn't stop because it keeps going up. And it's momentum, pure momentum. People are just jumping on it. Tesla is up almost another $100 today to new highs. Danielle talked earlier about the wealth inequality. Wealth inequality is getting ridiculous. I mean, I guess it's Amazon we were talking about or Apple, I guess, is a $2 billion company. That has added $2 trillion. That's added $1 trillion since the March low alone. And a lot of those companies have. The NASDAQ is almost at a double versus the March lows. So, but really in recent weeks, it's been a narrowing, even more and more and more, lower volume, bad technicals, with 0 pullbacks. So it looks like it did in January of this year, and it looks like it did in the fall of last year with almost no pullbacks. And so it'll turn, but it'll turn on when you least expect it.
Yeah, so just a couple observations on that. One, three of us with Chris last night did a private webinar for your New Harbor clients. And in there, Chris was saying that he definitely thinks that this market meltup does have a date with destiny at a maximum of middle of next year, and that's for reasons related to oil and oil supply, and that's a whole other discussion that we can't get into right now. But basically, Chris is saying, hey, look, I don't know when this thing is going to roll over, but I can tell you that it's going to get a lot harder for the market to continue powering higher once this supply crunch begins to really kick in. And I think maybe the inside bet is on some sort of civil unrest before that. And obviously we got the election to go through, and that's going to be a rocky time no matter who wins. But if this level of inequality persists, and if it continues to accelerate at the rate at which it's currently doing so, I think there could be a time perhaps before Chris's sort of mid-2021 prediction there, where there's something that forces the system that's totally unexpected or exogenous, like a populist uprising. So that's going to be really interesting to see. All right, guys. So we're pretty much at the end of our time here for this week. We've had a great run of guests of late. Really super excited at the high caliber of expert that we're getting to bring on the show here. And it certainly gives us lots of great fodder to talk about. In closing, guys, I'll give my super quick, reminder for folks if they're looking for a financial advisor, what to do. But anything in parting here in terms of either what we talked about or what you're seeing in the markets that you'd like folks to know? John?
Nothing that we didn't cover. Again, I think now more than ever, having perspective, having data to ground one, at least into understanding the leap of faith that they are making or potentially going to make if they're jumping into these markets, that is absolutely critical. Without that, I can't emphasize enough how bloated, how overvalued these markets are for folks if they're jumping in right now.
Okay, Mike?
More of the same, I think, Adam. I don't really have much to add in terms of what we already said. Just be cautious. We'd be happy to talk to anybody if they want to get our opinion on what they should do.
All right. So folks that are watching, you've heard from John and Mike, time for extreme caution, really think defensively. Markets have been incredibly distorted and only seem to get more so week after week after week as we're doing this. Of all, the long stretch of speakers we've had, whether they're markets, technicians like Joe Saluzzi, right, who really understand how the markets themselves work, whether it's people who, are close to the Fed like Danielle, whether it's people who are macro strategists like Michael Pinto, whether it's people who are technical analysts like Sven Henrik, they're all saying this is an incredibly dangerous time, treacherous time for investors. So it's not, it's not the time to just sort of blithely, if you're in the markets, being in the markets with your eyes closed and just trusting the system. I think Danielle did a really good job today as an insider, as a reminder. The Federal Reserve, Congress, she's telling you the people that are running the show are doing a really bad job of it and that they're just in scramble mode. Right. So if you are not working with a financial advisor right now that understands these risks, that's our number one recommendation to you, which is don't go it alone. It's super treacherous time for investors. Make sure you're managing your wealth, your financial wealth, with the guidance, under the supervision of a financial advisor that understands these risks. If you've already got one and they're doing a good job for you, fantastic, stick with them. We think you absolutely should do that. But if you don't, or if you're having trouble finding one, every week we recommend that you guys give the guys at New Harbor a call. You can have a free consultation with them. There's absolutely no obligation to work with them. It's completely free. And if that's something that's of interest to you, stick around at the end of this video. We give you all the details on how to do that. Mike and John, as you guys are talking in the video here, I'll put up that Greylock Peak URL like we do every week so folks know how they can contact you. And with that, guys, I'll say what I say every week, which is I'll see you next week, and hopefully the markets give us something more interesting to react to. They haven't done much so far. My fear is one day they will, and they'll do in such extremity that I'll probably regret making that wish. But until that time happens, guys, we'll continue to watch the markets, and we'll be in touch. See you next week.
Sounds good, Adam. Thanks. Take care. We'll see you next week.
Enjoyed it.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market's always going to take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.